Welcome to the Deep Dive. Today, we're really getting into it with Ola Electric. We've got their Q1 FY26 investor presentation right here that covers up to June 30, 2025.
Yeah, pretty detailed stuff.
And we're going to put that alongside some, well, very fresh news updates from just this month, October 2025.
So look back and a look right now.
Exactly. Our mission today is to kind of wrap our heads around what feels like a pretty critical moment for them. You know, this high-profile EV company, they're talking about a major strategic pivot.
Moving away from that super aggressive growth.
Right. The grow-at-all-costs phase seems to be ending. They're now aiming for, what do they call it? Balanced, profitable growth.
The classic transition for these kinds of companies.
So we need to look at the actual financial data from Q1 that shows this pivot hopefully working, and then, contrast that with their huge bets on vertical integration, building everything themselves, and also the tough stuff they're facing right now.
Regulators, the stock market. Real-world headwinds.
Yeah. This isn't just numbers. It's really a story about how a disruptive tech company tries to, I guess, institutionalize itself. Get control of costs, manage risks like supply chains.
While fighting off all sorts of immediate pressures.
Yeah. So if you're interested in how these fast growth outfits try to turn, let's be honest, sometimes operational chaos into steady profits, stick with us.
Well, that shift, from just grabbing market share to actually making money, that's pretty much where the whole EV industry is right now, or heading.
Makes sense.
The source material, the presentation, it's quite clear. They feel they've got the early adopters, the people who wanted the newest thing.
Okay.
Now, the game is shifting to the middle mass, the average buyer.
And they care more about price and reliability, presumably?
Exactly. So a strategy built purely on, say, subsidies or just being first. That has to change. It becomes about profitability, about the underlying cost structure.
Okay, so does Q1 show they're actually doing it? Let's get into the numbers that might prove this pivot. Deliveries first. 68,192 vehicles for the quarter.
Solid number. Not earth-shattering growth, maybe, but solid.
But here's the bit they highlighted, the thing they were aiming for internally. The auto segment actually hit EBITDA positive in June 2025, just for the month, but still.
That's a huge milestone, psychologically massive, but also operationally. It shows it can be done.
Yeah, and if you look at the whole quarter, the improvement is, well, it's pretty dramatic. Auto segment EBITDA margin improved to negative 11.6%.
Which, okay, still negative, but you have to see where they came from, right?
Exactly. The presentation notes they were at negative 113.9% on a consolidated basis just the quarter before Q4 FY25.
Wow. So dropping over 100 points off that loss ratio in, 3 months? That's quite something. That takes effort.
For sure. And it looks like it came from two places. Better margins on the bikes themselves and some pretty aggressive cost control.
Let's break that down.
Okay, gross margin, what they make per vehicle before overheads, hit a record 25.6% in Q1.
Best ever for them. That's healthy.
And they're aiming way higher. The target is an exit GM for the full fiscal year of 35 to 40%.
Ambitious. Is that with government incentives?
Yeah, they mentioned that's with the full PLI benefits factored in production-linked incentives. Government support for manufacturing locally.
Okay, makes sense.
Yeah.
And the cost side.
Ruthless is the word I use.
Right.
To actually name the program Laksha.
Right.
And you see the results in the operating expenses, the OPEX. Auto segment monthly OPEX dropped from 178 crore rupees.
Just to clarify, a crore is 10 million rupees, so we're talking what? Around 17, 18 million euros or dollars a month?
Roughly, yeah. Down to 105 crore rupees a month in Q1. So shaving off like 70-something crore a month, that's huge.
That's a serious reduction. And they think they can hold the line.
They believe they can stabilize the consolidated OPEX, so across the whole company, around 150 crore a month by the end of FY26, even while planning to basically double vehicle volumes.
Now that is operating leverage. If they can pull that off, controlling costs while volume scales, that's the dream.
And it flows through to cash. The presentation says the auto business was almost neutral on operating cash flow in Q1, expected to turn positive later in the year.
Getting closer.
And free cash flow, still negative, but much better. Negative 107 crore for the auto segment in the quarter. The cash burn is definitely slowing down.
Okay, so the pivot seems to be showing up in the financials. But, when companies grow this fast, there are always questions. Quality, warranty claims, that's always a big one for investors.
And the presentation tackles it head on, which tells you it's been a sore point.
Definitely. They mentioned taking a big one-time provision, right?
Yeah, a substantial hit. 250 crore rupees booked back in Q4 FY25. That's like $30 million USD, set aside specifically for potential warranty issues on the older Gen 1 and Gen 2 products.
Okay, so they are acknowledging past problems financially?
How I read it, taking the hit. But they follow it up immediately with data claiming things are getting much, much better.
What are the numbers?
They say Gen 2 claims are 30% lower than Gen 1, and the newest Gen 3 scooters. Claims are already 60% lower than Gen 2 was at the same point in its life cycle.
60% lower than Gen 2. That's a significant jump.
Yeah, they're pretty confident estimating Gen 3 has the lowest fault rates in the whole industry.
Okay, but why? Is it just better assembly line work, or is there a specific tech change?
It seems to be very specific engineering, and this ties right back into that vertical integration strategy.
How so?
Remember the Gen 1 models? They used hub motors sourced from suppliers.
Right.
But for the Gen 2 S1 Pro and then all the Gen 3 models and the new Roadster, they switched to their own in-house mid-mount motor design.
Ah, okay, so they control the design and manufacturing of the motor now.
Exactly. And the presentation is incredibly direct about the impact. This in-house motor has a 90% lower failure rate. 90%. Compared to the old supplier hub motors used in, like, the S1 Air.
Wow. Okay, that explains the warranty claim drop. That's vertical integration paying off not just in cost, potentially, but directly in product quality and reliability. Huge.
Massive difference. And speaking of paying off, they've also spun up a completely new high-margin revenue stream that isn't hardware.
The software.
Yeah, the MoveOS Plus paid software features, things like advanced navigation, music, modes, etc. In Q1, 50% of new buyers paid extra for these features.
50%. What was it before?
Get this, only 2% in the previous quarter, Q4 FY25.
Whoa. Okay, that's a huge jump in adoption. And pure margin, essentially. Software revenue on top of the vehicle sale. That's the model everyone wants.
Absolute game changer for the financials if they can sustain that.
It really decouples revenue from just, selling metal, leverages the fact these are connected vehicles, which actually brings us neatly to their bigger strategic defensive plays. Vertical integration again, but this time looking at global risks.
Right. Let's talk about rare earths. That's a long-term vulnerability for any EV maker using high-performance permanent magnet motors. Big geopolitical risks there.
Huge dependency, mostly on China.
So their short-term fix, according to the presentation, is just managing it. Sourcing magnets from 2 different countries, holding more inventory.
Yeah, a Band-Aid, basically. Important, but not a solution.
But the long-term plan is way more aggressive. Get rid of rare earths entirely.
Exactly. Accelerated development of rare earth-free motors, ferrite motors.
This completely sidesteps that geopolitical choke point.
And potentially lowers costs, too. Now, what's really interesting is the timing. The Q1 presentation said they aim to start productionizing these in Q2 FY26.
Which started in July 2025?
Right, but the news from this month, October, confirms they've already got government certification for this new ferrite motor.
Wow, so they're actually ahead of schedule on deploying this.
Seems like it. That's a significant strategic win, removing a risk and potentially gaining a cost edge faster than planned.
That really shows them making decisions based on resilience, not just immediate cost savings.
Okay, the other massive bet, the 4680 battery cell and the Gigafactory.
The ultimate vertical integration play, making your own batteries. The most expensive part of the vehicle.
And the most complex, technologically.
For sure. The update is, cell production is basically ready. They expect vehicles using their own Bharat cell to start deliveries by Navratri.
Which is this quarter, Q2 FY26. So very soon.
Very soon. And the scale is just huge. The full 5 gigawatt-hour Gigafactory plant budget is 2,800 crore rupees.
About $340 million USD.
Yeah, and they've already spent 1,500 crore of that. That 5 GWh, they estimate, can support about 1.2 million vehicles a year, assuming roughly 4 kilowatt-hours per scooter.
So they're building capacity for massive volume, but are the cells any good? Or are they just making standard batteries?
That's the key point. They claim their in-house 4680 cell. That form factor is already 10% better in energy density than current top-tier 2170 cells.
So more range or power for the same size and potentially cost. That's the implication. More energy packed in. And they're not stopping there. The roadmap includes a V2 cell and also LFP cells, lithium iron phosphate, planned for late next year.
LFP is usually for lower cost, right?
Generally, yeah. Less energy dense, but cheaper and longer lasting. So they're developing options for different segments. This is how you compete globally. You try to out-engineer on the core tech.
One more tech piece, ABS, anti-lock brakes.
Right. Safety regulation coming in. The presentation notes they're currently the only major EV two-wheeler player with an ABS model, the S1 Pro plus Roll.
but it'll be mandatory soon. January 2026 deadline.
Exactly. So rather than just buying ABS systems from suppliers like Bosch or Continental, they're developing their own in-house ABS system.
Another vertical integration move.
And timed perfectly for that January deadline. If they can make it themselves, what becomes a mandatory cost for competitors potentially becomes a margin advantage for Ola.
Okay, so summing up the internal picture from the Q1 report and these tech updates. Cash burn slowing, margins heading up, quality improving dramatically thanks to in-house tech, major strategic projects like ferrite motors and cells seem on track or even ahead.
It looks pretty strong internally.
And the forward-looking targets reflect that confidence. For the full FY26, 325,000 to 375,000 vehicles sold. Revenue between 4,200 and 4,700 crore rupees.
Significant numbers.
And auto EBITDA positive for the full year, targeting 5% plus. Plus, they seem well-funded, with nearly 3,200 crore rupees in cash at the end of June.
Right. That's the, let's call it the optimistic engineer's view based on their own plans and progress.
Okay, I sense a but coming.
Well, yeah. Now we have to look outside the company walls. The October 2025 news paints a much messier picture. All that internal success is happening against some serious external turbulence.
What's the biggest storm cloud right now?
I'd say it's the clash between regulation and their operational model, especially in their huge home market of Maharashtra.
Mumbai State, right.
Exactly. The state government just put out these draft motor vehicle aggregator rules 2025.
Aggregator rules. So this hits their ride-hailing business.
Precisely. Which is a key part of the ecosystem that drives scooter sales, especially for gig workers. These rules are strict. Things like capping surge pricing at 1.5x the base fare, mandatory driver training, fixed working hours, and rest periods for drivers.
Whoa. Capping surge pricing directly limits how much money the platform, and by extension the drivers, can make during peak times.
It's a direct hit to the economics, and compounding that.
Let me guess, the drivers aren't happy either.
You got it. The news also mentions a big statewide protest, basically a strike, by Ola, Uber, and Rapido drivers on October 9th. Services were disrupted.
Why were they striking?
Demanding fare revisions.
Yeah.
Higher pay, essentially. So you've got the government putting a ceiling on fares and the drivers pushing up the floor on costs. That's a really tough squeeze.
A brutal squeeze on the economics of the ride-hailing system that helps sell their vehicles. It's like global strategy hitting very local, very difficult friction.
Perfectly put. And all this technical brilliance, the Ferrite Motors, the Gigafactory, the stock market isn't exactly cheering yet.
How's the stock doing?
Not great, according to the reports. Down 42% year-to-date as of October. Investor sentiment is still pretty negative. Seems like the market is still hung up on the history of losses, maybe worries about the fundamentals despite the recent improvements. We saw reports that big investors like the mid-cap fund Helios have been cutting their stake.
So the market needs to see more proof. Sustained profitability over several quarters, maybe?
That seems to be the message. They aren't buying the jam tomorrow story from the vertical integration just yet. They want to see the jam today in the quarterly results consistently. And market share has apparently slipped since March 2024, even though they still lead in unit sales.
Okay, so it's this really fascinating split screen. Inside the company, executing a pivot, hitting tech milestones, controlling costs. Outside, regulators squeezing, drivers protesting, investors staying skeptical. Oh, and one more funding note.
Yes. They raised 400 crore rupees by issuing special preference shares, OCRPS, to Ola Cell Technologies. So funding the battery side specifically, more investment in that vertical integration.
Right. It just reinforces the core tension. They're building this incredible technological moat, self-reliant on motors, cells, maybe even ABS soon, to manage global risks and costs. They seem to be successfully turning the ship towards profit.
Technically, yes. Operationally, yes.
But at the exact same time, they're facing intense pressure from local regulators, from their own driver partners, and from a very wary stock market.
Which really sets up the final thought, doesn't it? A question for you, the listener, to ponder after hearing all this.
Go for it.
Okay, so Ola's pouring billions into proprietary tech. The 4680 cell, the rare earth-free motors, the ABS system. They're doing this explicitly to control their destiny, manage costs, avoid geopolitical shocks.
Yeah.
But how much will their ultimate success really hinge on that tech superiority versus their ability to navigate the messy, local, ground-level stuff?
You mean like the Maharashtra aggregator rules? The driver economics?
Exactly. Can you really sell 350,000 scooters a year, hit those ambitious targets? If the ecosystem that supports a huge chunk of your buyers, the ride-sharing drivers, is being choked financially by state rules and local unrest, which battle is actually harder to win? the engineering one or the regulatory and economic one on the ground?
That's a really sharp question. Technology versus the street level reality, something to definitely think about.